Welcome back to Reform Millennials, a podcast where we discuss the intersection of markets, politics, and pop culture. Please remember that the content of this show is for educational and entertainment purposes only. Nothing should be considered financial or tax advice. Please consult a professional before you make any investment decisions.
Good morning, Joel.
Morning, Mel. Nice to see you again.
Good to see you too.
It's been 2 weeks. I feel as though it hasn't actually been as crazy, which is, I think, just summer's here. Sell in May and go away.
I was actually saying this morning. I, for the first time yesterday, felt like not being dialed in for 12 to 14 hours at my desk wasn't like a damaging thing to my work product. I feel like we are starting to let off the gas a little bit when it comes to the intensity, which is good because this has been a crazy last few months.
It's been a busy year for most, pretty much across the board. Interestingly, for myself, it's often said that, people sell in May and go away. All the important people go to their summer homes for the summer and they spend time with their children, school's out, etc. But at the same time, the market is about to raise capital for the largest IPO in history. Google just raised $80 billion via capital or via equity stake that was anchored by Berkshire Hathaway. We have news galore across the liquidity spectrum and the United States AI market. And it's going to be very difficult for the important people who make their money raising capital to go away for the summer. So I think this ties in pretty nicely with my little opener that I wanted to chat through. And it's like, for the last 3 years, every conversation has kind of talked about, is AI a bubble? And is it real? Who's going to win? What inning are we in? And I've been very busy saying that for the last 3 years, we're kind of coming up on inning 3, 4. And over the next 6 to 9 months, we're going to see a lot of capital get moved around. The reality is that AI has continued to deliver on the efficiency front, on the productivity from a productivity point of view. It continues to be very real, and humans are integrating it into their workflows, into their lifestyle. But what I want to talk about today is what I believe caused our bloodbath of last week on Friday, and then to a similar extent today. Very recently, we saw, and this will sound odd to most people listening, but we had the United States issue a jobs report. That jobs report came out very hot. That jobs report came with backdated changes to the previous 2 reports. Those reports also indicated that the job market has reversed from there being less open opportunities to there being significantly more. That tells the market that we are in a very hot economy. Now, what has been priced into markets for the last 2.5, 3 years has been a continuation of rate cuts. Money was going to get cheaper. They were going to stimulate the economy. But last Friday, that jobs report was too good. Stronger hiring, upward revisions. This average has spiked upwards. And when the cost of money goes up, so the multiple that people pay for duration, or said more understandably for regular people, is high risky, high beta, fast moving momentum stocks like artificial intelligence. They will then get re-rated downwards, because if we start to see the cost of money going up, the compensation required for return also has to represent that. So the 2-year treasury broke out to a 12-month high. And this is all during a period of time where the Fed chairman is on his way out and is being replaced by Moran. We have a Donald Trump situation where he has a war going on in the Middle East. He has a mandate from the people to bring inflation down, which just has not occurred. He has a midterm election cycle that he has to deal with. And all of this is starting to really become a headwind for him and the market. So if you sit with that for a second and think about like how people are positioned, how the market has rewarded investors for the last 2 years, it is a stark change. So now, how are we going to deal with this? If AI is a bubble, we're in a difficult position. However, I think the better question is, where's the money actually flowing inside of all of this? And what is going to happen to all of it if this bond market continues to break out? So to me, there's this balance that needs to be struck. So obviously, for the last 2 years, bottlenecks and the return has all aggregated to Micron, so memory, to so DRAM, NAND, et cetera, to the photonics names, to power, to VE Vernova with turbines. All of these companies have largely benefited, and many of them are up thousands of percent. And it's very likely that if we continue to see an escalation or a continuation rather of jobs being and wages increasing, it's going to be very difficult for the Federal Reserve to maintain a backdrop of cutting rates, which would then make it very difficult for the Canadian version of the Federal Reserve, Bank of Canada, to continue cutting. All of which is very difficult for Canada, given the fact that we are not in the same economic position. So for both of us or both countries to be in this stark difference in terms of economic condition, while also trying to manage a situation which is largely beneficial to the United States as a whole, but less so beneficial to Canada as a whole, but very, very beneficial to Alberta, with oil prices being at $80+. We are in a very difficult situation. The United States, hot. Europe, struggling because you have input costs going to the moon. The rest of Canada, outside of a very productive export-heavy West, is also in a recession. Where are we going to go? This is a very fun tape or market to invest through for myself. I don't know if I've had more fun than I have had the last 18 months. And I think as an Albertan, it's put us in this fantastic position. And that might sound terrible given that a good portion of the rest of Canada is not doing terrific. However, it's that leverage that we've needed for a very long period of time. So I guess where I want to go to next is kind of like this market update. So again, 10-year treasury yields, 4.57%. This is a breakout highest point we've seen in 12 months. US large caps have done incredibly well. We have an S&P that's up 6-7% after a 4% drawback, having a decent year. Now you start to take a look at the internals of all of that, and you have an equity risk premium that doesn't quite balance out when you start to look at what the 30-year treasury rate is pricing in. If you can get a 10-year treasury yield at 4.57 and the equity risk premium is currently pricing at 4.56, what's the point in investing in stocks? We're fully valued. What do we do? Something that's important for people to remember and to understand is that the last 30 years of global stock returns, and what I'm going to talk through here today is this paper from Hendrik Bessenbinder, which talks about 64,000 global stocks for the last 30 years, which includes data from the dot-com bust, the financial crisis, 4 different recessions, basically every bad thing that has occurred during my lifetime. What this research has showed is that he found that 1% and 2% of stocks have created all the net wealth above the US Treasury rate during that 30-year period. The other 98 or 99% in aggregate netted to roughly the value of Treasury bills. So 55, or roughly, depending on the market you're looking at, 55 to 57% of stocks during that 30-year period underperformed T-bills. So when you have asset managers who are broadly diversified across 50 stocks, 100 stocks, you better hope they're very good at picking winners in order for them to outperform market, but then also outperform T-bills. Because when you start to think about, okay, so you're telling me that in 64,000 global stocks, let's say we just bring it back down to the S&P 500, you have 500 names, and you're telling me that only like 410 of those or 12 of those outperformed. If you don't own those in your portfolio, you have gotten wrecked, or you've just underperformed for the amount of risk that you're willing to take. And that is a problem. And interestingly, that those stocks that people own are oftentimes the most controversial or difficult to understand, or perhaps, like, certainly the last couple of years, it's been easier to buy Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, et cetera, Walmart. The next 30 years is not going to look the same. However, I'd be willing to bet that the same thing does occur, in that the same 1 to 2% of those 500 stocks or 64,000 stocks are going to generate the lion's share or all of the alpha generated above treasury bills. So if you don't and aren't going to be willing to invest for the future as this paradigm evolves, you are going to miss out. And over the next 6 to 9 months, we're going to get Anthropic IPOing, OpenAI IPOing. SpaceX goes out today/tomorrow. You have very likely Anduril that is going to go public. Stripe, which is the biggest payment processor that's private, it's going to go public. You have some of the greatest entrepreneurs getting liquidity and going public coming soon. And what has been the biggest question to me from clients and from people that value my advice, which is whoever that might be, not very many, the biggest question has been, like, what are these IPOs going to do to the market? How is it going to impact valuations? What's going to happen to all the money? And I think what's really important an important way to frame this will be when you think about the capital that's being raised. So SpaceX is raising $75 billion. This is 3 times the size of the second largest IPO in history, which is Alibaba, and that went out in like 2016-ish. This is the largest IPO in history. The equity being raised here is going to provide an enormous amount of wealth. Just think about the people that had invested in SpaceX 20 years ago, who are now getting exit liquidity at multiples of their initial investment that is staggering. We're talking about life-changing money for thousands of people. This is the superpower of America. I had this conversation with a client just yesterday, and I asked them, like, which city in Canada has produced most recently the most millionaires? And I think, Mel, you probably would answer this as being, like, which city would you guess?
Hang on, let me think about that. The most millionaires. Maybe would it have to do with I want to say Ottawa, but is that crazy?
That's correct.
Okay.
So
yeah.
Shopify
Is what I was thinking.
Because it's the most successful tech company in Canadian history, has minted many hundreds of millionaires as a result of its success. Early employees, investors, etc., all generally working in the Ottawa area are getting liquidity, or rather have benefited from the fact that the stock has gone from being a sub-billion dollar valuation to being the second most valuable company in the country. That produces an amazing amount of wealth that has then reinvigorated the city of Ottawa to then become a tech hub. Now, think about what this is going to do to the areas in which Anthropic lives, where SpaceX lives, OpenAI, Anduril. All of these incredible innovations is going to generate an enormous amount of liquidity because of these public funding raisings. And it's going to then spur a whole host of new innovations and a whole bunch of entrepreneurs and investors that will then go and back the future of tomorrow. This is the flywheel effect of America that is so powerful. Now, I want to also add that this will create this incredible liquidity event. Many people think this is going to suck all the money out of all other stocks and then cause a correction. However, what I want to then draw other people's attention to is that there are the largest pools of capital that do not have a mandate or access to private investments such as these. So you have Fidelity, T. Rowe Price, Manulife, Sun Life, all of these enormous funds that do not have an allocation to private companies. They aren't investing in Anthropic. And if they are, they can actually only do up to 15%. So these pools of capital are larger than sovereign wealth funds. This is the largest money on the planet. And they are now going to have to allocate to these businesses. That is where the money is going to come from. This is not going to be a market problem. And if it is, it's only going to be for a very short period of time. And so when we start to do the math on how this will then be digested, I just hope that anybody listening is going to realize that the global equity market is enormous. It's $100+ trillion. It's going to be able to absorb $400 billion equity raise. And it's going to be able to come from all of these enormous pools of capital that have not had the opportunity to invest in some of the most innovative and incredible entrepreneurs and businesses of the last 10, 15 years. So this all comes back to this research paper that came out, and I'm going to link it in the newsletter, but it speaks to where you need to be investing in your portfolio as a person thinking about where the future is going, because it's quite clear that the last 30 years has been dominated by 15-ish, 20-ish companies, 1 or 2% of the 64,000 global stocks. And the next 30 years is going to be the exact same thing, but it will not be the exact same companies. It's almost certainly not going to be. So we need to take that into consideration. So Mel, that kind of moves me into the SpaceX. And one of the underwriters is RBC, the business I work for. They're raising $75-ish billion. That's an enormous amount of money. Hilariously, it's double subscribed. They had no problems finding the capital for it. The amount of nuance and chatter about it online has been kind of interesting. I'm going to have a post going out today about the valuation. So at $1.75 to $1.8 trillion, it seems like an outrageous number, obviously. That seems so silly. However, when you start to break down the prospectus, it's kind of a hilarious event. They're claiming that they have a total addressable market of $28.5 trillion, which is kind of outrageous. That's the largest TAM in human history. The reality is this is Musk's superpower. His ability to iterate, react, and then build in the face of ever-changing markets. Like, I'm quite certain that when he started SpaceX, he didn't think he was going to be putting data centers in space. That wasn't really the game there, right? He's been able to deliver on and build incredibly difficult engineering and hardware problems that he is then able to, I think, spin and then develop a business case post. So you have three businesses inside of SpaceX. You got rockets, you have Starlink connectivity, and then you have XAI and X being Twitter. The Twitter business is a dumpster fire. XAI is, for all intents and purposes, a dumpster fire. Before he merged the two 6-ish months ago, the business itself was profitable. You then bring in this XAIX enterprise, and it has this unfortunate reality of making a negative cash flow business. So what's funny about all of that is that space and rockets and Starlink connectivity as a percentage of this TAM is only about like 6% or 10%. So Musk knows that he ends up, XAI and X, which was largely funded. I don't know if you remember this, like during the Trump election. Prior to that, he had Biden that forced him to buy it. Biden forces him to buy the business, and then he gets all of his buddies to come in and help him fund it, right?
Yep. And
the one dirty little secret about Elon Musk is, and what I think has made him so darn, and I've changed my tune on this man multiple times, is that he has always made sure that his liquidity and his investors make money.
Yeah.
And his best friends come to the table and fund his $25 billion buy of X, or Twitter at the time. Very clearly overvalued, all of it silly. However, 3-4 years later, that $25 billion allocation gets merged into the hottest IPO in history. So they now are getting their liquidity via SpaceX, Starlink being combined with XAI and X. But what it also, luckily for him, delivers, and prior to Trump taking office and Biden making him buy Twitter, we didn't really have the ChatGPT moment and IO moment. We didn't know what the value of data centers was going to be. And he ends up merging X with XAI. He starts building Colossus, which is the United States' biggest data center project, and then chip manufacturing facility. And he then has the ability, as the world's greatest salesperson, to take his total TAM from 2 trillion via Starlink and the space rockets business to a whopping $28.5 trillion TAM, because the new valuation of AI is infinity. This is just such an incredible way of understanding how to raise money, how to satisfy your investors, make sure that they are happy first, that your first responsibility as CEO and as investor, or rather steward of capital, is return on that capital, because that is what they invested in. That's what those people are supporting you for. And it's not signal. It's not to play these like pander games. It's that your job is to invest in the future, to produce a return for your investors. And Elon Musk is incredible at it. And he never forgets that reality.
It's just such an excellent example of, it feels like over the past 10 to 15 years, society fell into a little bit of a loop that thought that, if we just click our heels 3 times and think about capitalism differently, we can make the behavioral economics behind this, though flawed, better than all others form of economic and social cooperation, that we could just change it. And, it really is an excellent reminder to me that rules of the game, and the game being capitalism and wealth creation and free markets, those rules, no matter how hard governments and politicians try to change the Overton window on certain things, those rules will withstand the test of time. And I think we're seeing that with Musk, because Musk is not a person who is without political controversy. And you see all these different types of movements through his connection with the Trump administration, et cetera, to sort of, remember when he was working at Doge, it was, boycott Tesla, all these different things. The reality of the situation is that the person who makes the gold makes the rules. And the nice thing about a capitalist system is that, maybe not to the extent that Elon Musk does, but we all have an opportunity to participate in making that gold if we are willing to be aware of and engaged with those markets. And so I think just being a hater is not an investment strategy. And I don't know if you want to talk about Ontario Teachers Pension Fund now, but that to me is just like one of the biggest examples of that rule holding true.
Yeah. So 2019, Ontario's Teachers Pension Plan invests $300 million or $300 billion into, or $1 million, sorry, into SpaceX. Still, like, not a small investment by any means. That stake is now worth $16 billion. 5,200% return in 7 years. Not bad.
I think we should contextualize those numbers as well, because the return on that investment alone is bigger than Alberta's heritage, or sorry, not bigger, more than half the size of what Alberta's Heritage Savings Trust Fund currently is. It is, a pretty decent chunk of the value of assets under management of comparable wealth institutional investors like IMCO, et cetera. And that is going to have what purpose? It's not going to have the purpose of making a bunch of people rich. It's going to have the purpose of giving hundreds and thousands of Ontario teachers a stable and reliable defined benefit pension plan for decades to come. So I think that it's a reframe on how capital can work to serve ends that we don't often think about. Like, is Elon Musk going to be rich off of this? He already was rich, but yes, there's no question that the people who create these companies and take that level of risk with capital become billion trillionaires. And if you want to have a political discussion of whether or not that should be allowed, I think that's a very silly use of your time and resources. But the reality is that a lot of other people benefit when those types of people are able to do well as well. And I'm not saying that there's a perfect system to this and that income inequality is not still an issue, but there is no other system in the world that would allow something like that to happen. an investment strategy that doesn't allow for those types of returns and that doesn't take those risks, like that's not a thing that's going to serve teachers, nurses, et cetera. So I think this is very important when it comes to how we define and contextualize the political and government decisions that we approve of or don't approve of. When we don't understand the relationship between those systems, we lose the plot, and nobody is served when we lose the plot when it comes to these things. So we're very passionately about this, and I think that it needs to be double tapped and underscored as many times as possible.
Correct me if I'm wrong. 2024, 2025, Doug Ford canceled a Starlink contract.
Yeah.
And Doug Ford's the Premier of Ontario, right?
Correct.
Ontario Teachers Pension Plan represents the Ontario teachers.
Correct.
Had a $300 million investment in SpaceX.
Correct.
That owns Starlink.
Do they?
So.
Oh yeah, there
okay, so you're telling me that they went against the best interests of their teachers' pension, the teachers.
Well, no, the investment was made before like the Trump stuff, because the investment was made in 2019. But I'm just saying, like, Elon Musk.
So they didn't sell the investment when they were.
Well, not to my understanding. I don't think they have any plans to sell, actually, even on IPO. But they still hold it, as far as I'm.
No, I know that. What I'm really pointing out here is the performative BS that occurred for the last 2.5 years. And I think you made a really great statement there. And I'm hopeful that we can continue to see that permeate through politics in Canada in general, where we can see the forest for the trees. We could see that the value generated from economic prosperity is going to benefit the masses, the pensioners, the people that help make the country great. And if we aren't taking care of the base that pays for, if we don't consider the hierarchy of outcomes and needs for human beings, we are losing sight of what has, for the last 150 plus years in Canada, made our country such a great place to be and such an amazing home. So I'm just hopeful that we can gain some momentum here.
And I want to be clear as well. There is always, in my belief, a difference between the belief systems that you have and the decisions that you make based on those belief systems. I want to be very clear that there is nothing wrong with being a person who is anti-Elon Musk, anti-pipeline, anti-data center. Like, if you want to be that person, we live in a free society. You're allowed to be that person. That's a totally acceptable point of view to have. I don't agree with you. And we can have a conversation about that, but there's nothing actually inherently wrong with that. The problem becomes when we have viewpoints that are actually antithetical to what the end game and duty that you have in managing investments. If you are asking for people who are in charge of the well-being of more than just your tiny belief system, but they're in charge of everything, and they have to think long-term and think about more than just, vibes. If you are going to put people like that on blast, like, I want to encourage you. And I mean, maybe you can edit this out if you want, but like, you're kind of an asshole if you think that you shouldn't invest in anything Elon Musk makes because he worked in the Trump administration and the Trump administration is bad. There are thousands of teachers that are going to have stable retirements as a result of somebody making decisions based on investment and returns decisions. So this is where I draw the line. Have your opinion, have your point of view, even vote for people who you believe have that point of view, but understand that intention does not always equal impact in these things, and making an effort to understand how that relationship comes together is, I think, something that we should all do with our own beliefs.
I completely agree with you. Where I want to kind of move on to next here is going to be the AI strategy that was tabled by the Liberal government, or Carney, I don't know, call it 10 days ago. I didn't really read much about it because it felt like the number was so small to be basically a nothing burger. However, I do think that what it does is sends a signal to the market, signal to entrepreneurs. And I want to get your gauge of if there's any meaning there.
So I am going to have a little bit of a pessimistic view on this just because maybe I'm just having a bad week, but I'm a little just jaded when it comes to our government's capacity federally to do big things. I'll sort of just recap, some of the main pillars involved in it. So yes, we have the artificial intelligence strategy. It's called AI for All. It's got 6 pillars that span from protecting Canadians and safeguarding democracy to creating shared prosperity to scaling AI champions to building partnerships and global alliances. And all of that, I'm not trying to be a hater. That is all very good. The problem that I have, and I talk about this all the time on this podcast and maybe sound like a broken record, is that you cannot take promises and strategies to the bank. This government and this Liberal government has a track record of not executing and not moving at the speed of business, even in industries where things don't move quantum leaps every week like they do in this space. And the reality of the situation is that you do not have an AI strategy that has any merit of actually benefiting Canadians unless you have data centers, unless you have climate and environmental and infrastructure policies that support the creation of data centers and the creation of talent, unless you have corporate tax environments and entrepreneurial environments that incentivize the types of behaviors that create companies, as you say, like Shopify and others that create the sort of unicorn plus environments. So I'm not trying to criticize at just blanketly the AI strategy, but the problem with a strategy is that it doesn't mean anything if you don't execute to it. And we don't execute. And we've already said on many different levels that we actually don't. Carney, to his credit, cares a little bit more about development than previously, but we don't have a strategy is a strategy. And I'm happy they're talking about it. I'm happy that there's an awareness that it's important, but the governments in general, and this Liberal government in particular, does sometimes get into the trap of like, oh, that's an important thing that we should be talking about. We should say something about it. But the actual important aspect here is doing something about it. And it does open up a whole bunch of questions and possible tensions and irritants that this government is going to have to make some decisions on when it comes to what it cares most about. Does it care about the more fringe aspects of being wholesale anti data center, anti-investment, et cetera? Or is it going to bring Canadians along by convincing them that this is where we need to go? Like you and I were talking before recorded, it feels a little bit like the data center debate, which, by the way, you do not have an AI strategy if you don't have a data center strategy in this country. It feels a little bit like data centers are just becoming the new energy projects in this country. And I want energy contracts to be built, but go back to what you were saying at the beginning of the podcast. The majority of growth over the next 30 years is going to be from 1% to 2% of companies, and those companies aren't going to be the same as they were before, and they're going to be in this space. So it does create an interesting sort of quandary, but I don't mean to be a hater. I just think there wasn't anything particularly revolutionary about the strategy that wins my heart or mind quite yet.
No, it's nothing new. It's also nothing innovative. It's just more checks, small checks with what I consider to be handcuffs attached to them. And that is never to me, a strategy that bodes well for entrepreneurs that take them. It's interesting, the most successful venture capitalists, which in our country tends to be the Canadian government, and I wouldn't attach successful to it, but they tend to be the funder of last resort for most businesses, because we just don't have that flywheel effect that the United States has. They come with handcuffs, they come with expectations, they come with performative morals attached that don't represent a capital stack that benefits shareholders. And when the government that is mostly voted on by people that are not competent in business, you end up getting incentives that make no sense. And so, as Charlie Munger has said multiple times before passing, is show me incentives and I'll show you the outcome. And we would do well to, pardon me?
It's actually okay that they're not the best at picking winners and losers the way that like a pension fund like the Ontario Teachers is, like it is an actual skill set to be able to understand what is worth putting money towards. And contrary to what people may think based on my perspectives on this, I am not for taxpayer dollars that are meant to maintain basic services and create sort of security and handle certain targeted things. I don't think that should be the number one priority of government. And we've seen governments have to step in that way because, as you say, they're almost stepping in because they've gotten in their own way in some circumstances. But we shouldn't ask the government to be able to do that. We should ask the government to create the situation so that can happen on its own in the private sector.
And I mean, we could talk about this until we're blue in the face, you and I. We prefer to see a smaller government hand, less winner choosing, more regulation reduction, and that produces just better overall outcomes. And
it allows more time to go to healthcare, education, social services, like all the things that we want our government to be really involved in.
Exactly. Or, I mean, maybe really involved in, maybe that's where we'd rather see our government dollars going to. In any case, I would love to see, I guess, less oversight and a more concentrated federal, provincial, municipal governments across the board in our country. But here we are. One thing I glazed over a little bit, but I actually think is important to most people that are listening to this podcast and just to the regular consumer in general. Apple had its WWDC keynote yesterday. And the reason why this matters for the show, or just for people listening, I know that I'd be willing to bet that 95% of people that listen to this podcast are operating on an iOS system. And I think that everyone understands that Apple is the most valuable consumer AI or consumer company on the planet, but it has largely fumbled the AI ball. It bungled the 2024 Apple Intelligence launch. They talked about how there's going to be Siri AI in 2024, and it didn't even ship. That is counter to the track record of Apple for the last 20 years. They always deliver. However, you would have usually saw that as a track record event for Microsoft that has now reversed itself. And that has, I think, been a massive headwind for Apple and its stock price for the last 3 years. But I think what it's provided is this like secondary option for folks that want to invest in what the outcome might be if AI is, and all this CapEx goes horribly wrong, because Apple has just not had the same outlay. You have Apple that is effectively renting out its servers. It's not investing in data centers. It has largely bought its large language model from Gemini Google, paying $1 billion a year, and kind of just like waiting and seeing. And interestingly, I actually believe, outside of it failing terribly at Siri AI, this is I think they're very consistent in the way in which they handle new technologies. They've always been happy to be second, third, fourth, fifth, sixth to the party, so long as they deliver better. And this is where I think fundamentally Anthropic has been right and OpenAI has been wrong. I'm sure the division on this podcast and people that listen of Anthropic users to OpenAI users is much more down the middle in terms of 50-50 versus an iOS versus like an Android user.
Yeah.
And the reason why I bring that up is because OpenAI has made its name as being the consumer-focused AI deliverable.
Yeah.
And Anthropic has been more on the productivity enterprise side. And it's important to identify those two things for this specific reason. The consumer is not interested in productivity. Now, Mel, please just step outside of your own body, because you're an entrepreneur, you're a business owner.
Yes.
You care about productivity more than almost anyone I know. Now, if you were to then go and talk to,
that's the thing, is like, it's,
I know, but that is you. However, there is a good portion of the world that is when they're on their phone, they're lean back. They're on social websites. They're watching YouTube. They're kind of just like taking a break. And as a result of that positioning and that way of interacting with their technology, they are not interested in a tree of agents. And they aren't interested in paying $150 a month for something that they basically are using similarly to Google. And because of that, OpenAI has struggled to find the growth beyond the consumer and has struggled to generate revenue as a result. And their failure to incorporate ads to their platform is the reason why Anthropic has surpassed them. And why is that? Anthropic went the enterprise route. Similar to you, Mel, enterprises only care about one thing, and that's efficiencies and returns on invested capital. And what has Anthropic been able to deliver? The greatest harness that AI has seen so far is co-work and its ability to integrate into the workflows of multiple different enterprises. And as a result, they've seen an enormous amount of demand for their tokens, for the data centers, or rather not for the data centers, but for their services, allowing them to then go and underwrite massive amounts of data center rental purchases, which you've seen in their most recent deals with AWS, with Google Cloud, and XAI, and the Colossus business. And Apple kind of sits in a similar situation where they are consumer focused, but at least, unlike OpenAI that has, I think, strategically missed the reality that you need to be in services and advertising in order to generate the revenue that you're not going to get from the enterprise, Apple has understood that. They own this consumer layer. And just like our conversation prior to this one, you're like, how much did you pay for that device, Joel? Because I bought myself a new studio because I knew that I was going to need it to continue to stay on top of the ever advancing AI situation.
In the next 20 to 30 years, along with there being different stocks, there's going to be different status symbols as well. Like, you don't want like a Rolex, you want like a setup in your home office that's got unbelievable computing power. And you're like, oh,
Yeah.
sorry.
And this is very,
top of
it's
the
so
line.
similar to the early 2000s, late 1990s. And we're just like, it's everything rhymes, but it's different, the same thing is occurring. And I believe that Apple is actually uniquely positioned here. They are going to be able to skip the AI CapEx war while maintaining its position on top of the consumer as the AI compute layer that everyone trusts. Yeah. They still have the walled garden around their phone, around the consumer, and they're going to be able, so long as they don't miss a shift in platform where we just up and leave and go to Anthropic's platform, if that then finds itself in a new location, they're going to be in trouble. But I believe over the next 2 or 3 years, that is not likely to happen. And the diffusion of AI is going to go through, especially on the consumer front, through Apple. And they're going to be able to, one, continue to own trust. They're going to be able to own the relationship with the Democrat liberal side of politics. And they're going to be able to position themselves so that they are good enough or even allowed to operate in the EU and in China, whereas the rest of big tech has made an enemy of those regions.
That is actually I actually did not even think about the jurisdictional aspect of it, because I think that like people don't even realize when it comes to the ability to operate within China, there are very few Western countries that are able to operate there in their sort of full and authentic way as they do in the other parts of the world. So that's a very good point.
So I find that it's getting a little bit it's receiving flack at the moment. However, I do believe that they are uniquely positioned, maintain that position. I think that so long as they can regain their footing on an operation system perspective, because I think it's really deteriorated over the last couple of years, so long as they can continue to build an incredible piece of hardware, that is the direction in which we're going. The most important IPOs of the next year are all hardware companies, with the exception of Anthropic and OpenAI being kind of a split between the two, being a software layer in addition to having this enormous capital outlay required for the data center piece. This is, I think, a resumption of the importance of Apple and their hardware layer that has been, I believe, kind of a background to earnings calls for the last 5 years. 2014, 2015, Warren Buffett invests in Apple at a historical low multiple of like 9 to 11 in that range. Everybody knows the result of that. He ends up making hundreds of billions of dollars over the next 12 years as Apple services ramps up. They start selling on top of the iPhone, the iPad, the Mac. And you're now buying their stores that they rent. You're using the Apple Music, you're using the App Store, all of that revenue generated all accrues to Apple. I think that this new acceleration in compute, our new signal that we have compute at home, that we have this infrastructure that we're buying from Apple, is just going to create and build the base that they're able to then build more services on top of. Because whether we like it or not, we trust them. They have never broken that trust. With the exception of not delivering on AI or Siri, which I think will come. I do believe that they are uniquely positioned, especially from a capital allocation perspective, for anybody who's trying to pick the winners of tomorrow.
So you definitely changed my mind on this topic when we chatted pre-record. So I'm glad that
everyone's just like, Siri sucks, man.
Yeah, but just even you have to look when you're looking and evaluating on what some of these things mean. You can't just look at one narrow aspect of them. You have to look at the big picture and watch those trends over time. And I think that's really important. So you definitely helped me out on that one before we hit record. So I am convinced of your position on that. You want to make that your ringtone?
I might actually. That might be the first time. 1 for Joel, 10 for Mel. With that being said, Mel, I'm going to let you go. Thank you so much for your time today. And I look forward to chatting with you in 2 weeks. That's all for today. Thanks for listening. If you found this valuable, please subscribe and share it with a friend. As always, the information on this podcast is for educational purposes only and should not be considered financial and/or tax advice. Please consult a licensed professional for your own personal situation. Joel is a registered portfolio manager and investment advisor, and clients of his and his firm may own securities discussed on this podcast.